Welcome back, and joining me for a look at the day's markets action is Schultz from Momentum Securities. Thank you so much for your time, Stephen. Let's actually start off with the stimulus, the briefing that we had on that stimulus on Saturday coming out of China, because we know that this is something that has buoyed the markets for quite a while. Did markets get what they expected there or not?
I think it's difficult to say, to be honest. I heard both positive and negative commentary after Saturday's briefing. And I think what it boils down to is the remaining uncertainty. So the finance minister, for those that weren't watching, has committed to taking on more debt. And obviously that is to stimulate the Chinese economy and fund fiscal spending. There was big question marks as to whether the fiscal bazooka was going to be adequately funded. But at the end of the day, no numbers were shared, which means effectively we've got to wait for the month-end parliamentary sitting, where hopefully more clarity is going to be given, but commitment. And I think really the underlying message is the market is somewhat successful in forcing politicians' hands in China. Now, I think the reality is fiscal spending is definitely needed to complement the monetary stimulus that they've committed to. But at the end of the day, the only real success factor is going to be when some of those disinflationary pressures can be arrested, and that's consumer confidence and tied to the property market. So I think a bit of a property-focused stimulus is ultimately going to be required.
Yeah, well, let's actually talk about that. You talk about this disinflationary pressure, and both on the producer side and the consumer side. And then you also look at the trade data that also came out, the imports and the exports, whose growth surprised to the downside. Is this just something that we can expect until that stimulus actually starts to filter through to the real economy?
Absolutely is, in my opinion. So I think what one needs to understand about the Chinese consumer, which is feeling significantly depressed at the moment, is that a large part of household wealth in China is derived from property markets. So there's massive household exposure to property prices, and property prices are exceptionally depressed at the moment. It's taken a while to get here. I don't think anyone was surprised by the fact that there was a property bubble. The extent to which the authorities have allowed it to deflate as quickly as they have has absolutely decimated consumer confidence, and that feeds through into all numbers, whether it's import exports, whether it's consumer spending, retail sales, you name it. But at the end of the day, I think that the government is trying to systematically take some of the steam and pressure out of the property market. So what it doesn't want to do is overcorrect by creating, I guess, reinflating the bubble that they've worked so hard to start unwinding.
All right. Well, talk about confidence, because there is a lot in the U.S. We have seen those U.S. markets clocking fresh record highs there. And of course, we know that the third quarter earnings season started on Friday with JP Morgan and Wells Fargo starting us off on a high note. Do you think that there's more steam that we could still see there?
Yeah, the contrast could not be more obvious between China and the US. I was actually quite interested to see the other day that US markets are up 60% from their October 2022 lows. So a lot of positivity priced into US markets. Funny enough, we're going into the earnings seasons in the US with perhaps the most sobering expectations, at least in the last 4 quarters. The markets are only really looking for about a 4% quarter-on-quarter gain in earnings. So the expectation isn't enormous, but it's off an exceptionally high base. And most of the expectation ultimately comes down back to the Magnificent Seven. So there the market's looking for gains of around 20%. So any misses there is going to be quite detrimental. Banks are off to a great start. We saw it last week, and it just spurs the market higher. So I don't think there's a lot of risk of disappointment, but this is clearly a stock picker's market. Any companies that disappoint are going to get absolutely punished. And those that outperform will certainly be handsomely rewarded.
Yeah, we'll talk about punishment, because we did have locally Carlgro M3 being punished by investors. I know that this isn't a very liquid stock, but more than 10% slump in the stock at some point. Of course, they released their interim results with the pressure on revenue there, but it's still growing on the bottom line. What did you make of those numbers?
I think anyone reading the numbers before looking at the share price would have been very surprised, because the numbers at first glance appeared quite decent. I think all the metrics are moving in the right direction, with the exception of revenue, which is down quite sharply from just under 700 million to just over 500 million. So quite a contraction in revenue. But that being said, I think that every other metric is moving in the correct direction. Headline earnings per share up 29%, and that's largely thanks to share buybacks and cost cutting. And a gross profit margin at a very respectable 30%, and a great pipeline of business. So personally, I think that what we've seen year to date is around 80% move to the upside for the share price. And maybe just investor expectations were unrealistically optimistic.
All right. Well, on optimism, let's get to your stock pick for today.
My stock pick this evening is Chipotle, which is a US Mexican style restaurant and grill. It's popular for responsibly sourced, no preservative, real raw ingredients. So think of Kauai in South Africa, but with a bit of a US Mexican twist. Fast food is obviously not one where there's any barriers to entry, highly competitive and non-existent client switching costs. But I think the fresh raw menu is a growing trend and does create some form of differentiation. The balance sheet is debt-free, and margins best in the sector at a respectable 29%, and currently trades at about a 15% discount to its own historic levels. So I think one that certainly is a little bit more resilient in a tougher market, and some great growth prospects.
All right. Well, thank you so much for your time and just giving us insight on what has moved investors' money today, Stephen. That was Stephen Schultz from Momentum Securities.